Well, Happy New Year. It's been a while since I've seen most of you. In a lot of ways, it's kind of like we were picking up right where we left off the last time I did this video, with the markets back in bear mode again. The S&P 500 was down 2.5% today and does have a bearish posture according to the market forecast. A large part of that is because of Apple. Once the world's largest publicly traded company. These days, because it's fallen so quickly, Microsoft is actually the world's largest company. But Apple came out yesterday after hours with a pre-announcement kind of warning that their sales were going to come in a little bit lighter than what had been expected previous to that. So that impacted a lot of those technology-oriented areas of the market here today. We did see a big deal here made in the biotech space today. Celgene is getting bought out by Bristol Myers, so that affected things to a degree as well. But largely, it's another bearish type of a day out there in the U.S. stock market. So we're going to concentrate our trade application example today on a sector that's really been struggling ever since the economy started to struggle. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's January 3rd, 2019. First of all, if you're new to these videos, welcome aboard. We're grateful to have you in our audience here tonight. Remember, you can go to our YouTube channel and subscribe to our channel there. And while you're there, check out in our description area, there's a link where you can sign up for our email distribution list that entitles you to seeing all the stocks that are giving you overbought and oversold cluster signals within the S&P 500. In addition to YouTube, we're heavy users of Twitter. Make sure you're following me there at Brandon Van Zee. And if you get value out of these free Market Outlook videos, make sure you're clicking like and retweet to let us know on our Market Outlook focus tweets. And then also on Facebook, we have a group established there. Feel free to check out that group web address embedded in the logo in front of you. All right, with that, let's go ahead and dive into today's analysis. As you can see, I've got chart 4B pulled up here in front of us. The S&P 500 was down about 2.48% today. The Dow Jones was down 2.83% today. The NASDAQ was down 3.04% today. Again, that's the impact of Apple that we're seeing there. And then the Russell 2000 was actually our leading index today. It was only down 1.85%. And I, of course, am emphasizing only because usually 1.85% would be a pretty ugly day. But in comparison to the other indices where Apple is a much more impactful candidate, remember, Apple is not in the Russell 2000, which makes it different than the other three indices we have here. Apple is in the S&P 500, Apple is in the Dow Jones, and Apple is also in the NASDAQ composite. So because Apple is not in the Russell 2000, the Russell 2000 was our leading index today, only down 1.85%. You'll also notice that the Russell 2000 is the only index currently with a bullish intermediate term posture. I know that very quickly with my eye because I can see the background color of that chart right there. Again, for those of you that are premium Market Scholars subscribers, remember that you can load up these charts and follow along with us as well. But that green background right there will remind you that we have what would be perceived to be a bullish posture using that intermediate term line on the market forecast. The other three charts, so up here with the Dow Jones, notice that dark pink. Up here with the S&P 500, that dark pink there, and then the NASDAQ composite, that dark pink there, that is telling us that we have bearish postures on those other three indices after today's ugly action. So it's been more of the same. You know, ever since we topped out in October, this has been a market that has struggled to get any footing whatsoever. Of course, we had that run of things where we had a lot of oversold cluster signals, and we eventually did get our reversion to the mean move, but unfortunately, that move looks like it's already starting to give way to go fall back into that prior trend of lower highs and lower lows. And so that is the assumption until we see something different going forward. Until we start seeing, breakouts to the upside above resistance, we'll assume that this market will continue to trend in the downward direction. So pretty ugly day there across the board. I wanted to take a quick step away, remind you that the 9 at 9 gets produced here in the mornings. I also posted on Twitter and Facebook and a few other places. But anyway, I mentioned some of the big deals that were taking place here today. Celgene was the leader here before the market opened at 9 a.m. Eastern time. So we had a good feel for what was really going to be affecting stocks here today. Celgene pre-market was up 33%. Gilead, one of its chief competitors, was up 3%. On the downside of the coin, Bristol Myers, which is was the company buying Celgene was down 8%, so investors were selling off the acquirer, maybe with the impression that they were spending too much money to be buying Celgene. And then, of course, Apple, that I mentioned, was down 8% in the pre-market. It actually ended up being worse than that by the time it was all said and done. So the 9 at 9 really did tell the story of the market here today. Also, while I'm over here, a couple of heads up items. For those of you that are premium market scholars, I did revamp the strategy lab. So we have our new strategies that are ready to rock and roll for 2019. It's going to be more of a factor focus this year. So I did produce the pre-recorded video regarding the 2018 recap of all of our strategies and how they did last year, and then a little bit of a sneak peek into what we're going to be looking at in 2019. So that has been posted on our events calendar up here, again, for those of you that are premium market scholars subscribers. Below that, you can see some of those results from 2018, an ugly year for most strategies out there. There were a handful of them that did manage to sneak by with better than break-even results, but like most stocks and most asset classes out there, most strategies struggled last year as well. So a couple different things going on there. And then, of course, the sector selector was produced last Friday as well. And I'll produce a new one tomorrow. While we're over here, since I'm talking about it, I do want to kind of just point out, notice that materials here is ranked 8th. In the most recent sector selector. We'll get into the trade idea a little bit later, but I just want you to identify that right now in the recognition that materials is one of our worst performing sectors at the current juncture. Also, we got back underway with our live premium classes at Market Scholars here today. I did teach my question and answer class here today, a taste of some of the content that was discussed there. Looking for some opportunities within the markets there was one of the questions. A question about how do you handle a portfolio of losses? What do you do going forward? Do you do any hedging or what have you? Looking at some guidelines and checklists for selling puts and covered calls. Taking a look at General Mills as a dividend growth investment. Taking a look at Waze as a dividend growth investment, looking at a REIT, Store Capital, and then taking a look at some rebalancing ideas within dividend-oriented portfolios, and then looking at OGE as a dividend growth investment as well. So some great content there that is posted now for those of you that are premium market scholars. And then David taught his portfolio management class here today as well. So a lot of great things happening here at Market Scholars for those of you that are premium members. All right, back on track with our charts here on Thinkorswim. Let me pop on over here to the 3 green arrows chart now. This is going to be chart 4C. And just trying to get a sense of what sort of trend trading conditions are we in right now, with the idea being that if you want to be a bullish trend trader, then it might make sense to look for 3 green arrows on some of the key indices that are out there. Unfortunately, that does not represent the type of market that we're in right now. Now, the good news is we don't have 3 red arrows either. We did for quite some time, so notice the shading on this particular graph turns pink when we have 3 red arrows. In other words, where we have price below a moving average, where we have the MACD below the 0 line, and where we have a kind of a reversal that's taken place within the stochastics. That did occur from basically December 7th all the way through December 31st, but we did get a little bit of a reprieve here where the MACD saw a little positive price momentum here in previous days, where that was kind of it stopped the 3 red arrow signal. Right now we have a mix of red and green arrows. So none of the 4 charts have 3 red arrows. None of the 4 charts have 3 green arrows. So we're kind of in no man's land right now. But I would say that the odds suggest that the bears have a slight advantage in the current marketplace. Even though we don't have 3 red arrows, we do still have lower highs and lower lows. And therefore, if you're looking for trend trades out there, perhaps some bearish ones are starting to emerge. Let's take a look here at our next chart setup now. This will be our 1040 crossover method chart, and this will be chart 4D. And as a reminder, within the last couple of months, we've had bearish crossovers on all 4 key U.S. equity indices. So even from a longer term perspective, we would have what is perceived to be bearish trading conditions here right now. Now, the first index to go as far as go negative and give us that death cross was the Russell 2000. Remember, that happened actually way back in October. The one that held on the longest with the positive crossover was the Dow Jones, but even that one kind of went the way of the small caps eventually, and had a negative crossover there between your 10 period exponential moving average. In this case, this is your 10-week moving average represented by the orange line. And then the blue line will be the 40-week moving average. And so it was back there in mid-December where we had that death cross, even in the kind of more substantial mega cap companies out there in the Dow Jones. So right now, it's bearish trading conditions, whether you're looking at the intermediate term period or whether you're looking at kind of a longer time period like we're looking at here with the 1040 crossover. Remember, these charts right here go back 3 years in length, so kind of gives you a sense that we just went through a very prolonged period of upside bullish price action, and now we've just recently given way to more of that bearish condition. So who knows how long it lasts? It could very well last a while if we don't get things figured out within our government situation, with the trade wars with China, and this, that, and the other thing. It just kind of feels like every day you wake up and you kind of brace yourself before turning on the news, because it just feels like another negative news story is going to come out and affect things. And that's kind of the shoot first mentality that the market seems to be in right now, making things a little bit more dangerous for those of you that are active traders out there, at least if you're active on the long side of the market. All right, let's take a look now at a couple of 12 grid analysis, starting with chart 4E. Now, this first 12 grid is going to be the intermarket analysis 12 grid, and this will be, just as a reminder, when we're looking at the green background colored charts, that tells us we have a bullish intermediate term posture. When we have a red background color, that means that particular chart has a bearish intermediate term posture according to the market forecast technical indicator. So a few things that stood out here to me today. First of all, yields, treasury yields, getting blasted again. It's been a pretty ugly ride here. It wasn't too long ago where people were freaking out about the rising interest rate environment. Well, we're really not in that environment anymore. We've now seen U.S. treasuries go all the way down to 2.55%. Remember, we were just at a 3% 10-year yield here not too long ago, just 3-4 months ago. So things have reversed course in a hurry. And of course, the opposite of that is also true. And when yields are falling like they have been up here, then of course the opposite of that is that U.S. Treasury bonds themselves, the prices of bonds, are going up. Remember, prices and yields work inverse to one another. And notice the big breakout we saw today on TLT. So if you are looking for some trends out there, perhaps TLT will get you done. Now, most people don't get too excited about trend trading the bond market, but that happens to be the environment that we're in right now. Traders, investors out there don't seem to be supporting the stock market too much, so perhaps there's a little bit better action there in the bond market. But TLT just keeps ripping higher, of course, has that bullish posture right there. Also worth noting is that gold looks really strong. Was watching an interview on CNBC the other day with the new Barrick Gold combined company. Some of you that follow that space know that Barrick was once the world's largest gold mining company. I don't know if it is anymore. It's technically based up in Canada, but they actually did a big merger here with Rand Gold recently. So Barrick is no longer traded under ticker symbol ABX. It's now traded under ticker symbol Gold, which was the old Rand Gold ticker symbol. So anyway, big merger there in that once forgotten industry. But all of a sudden, it seems like gold is kind of coming back to life again. Notice that down below here, this is your gold commodity chart. So this is not the price of any mining company within the gold space. This is gold prices themselves. And so gold is knocking on the door of about $1,300 per ounce at this point. And you can see some really strong action here. And this is something that we were identifying even late last year, just that it was starting to garner strength, and that has continued up until this point. We are seeing that the US dollar struggled today. It was down 0.55%. Notice that we now have a bearish posture on the US dollar, which could enhance the likes of things like gold or other commodities that are priced in dollars, or even on a relative basis, some of those foreign securities that are out there. Also worth noting is that the VIX was up pretty strongly today. It was up about 9.6%. So fear kind of was back in vogue here today as the stock market sold off. Let's take a look at our next chart setup now. This will be our foreign stock market setup. All right, as we look at this, again, one of the things that stands out to me immediately after just making the comment a moment ago regarding the US dollar is notice that as you look at this 12 grid here, none of these foreign equities indices here did worse than the stock markets in the United States, at least the S&P 500. The worst performer of these 12 that we're looking at here is India. This chart up here on the top rung, it was down 2.16% today, but that still outperformed the S&P 500. We had, in some cases, some of the foreign markets that were actually up. Notice that Brazil was up 0.64% today. Russia was up 0.21% today. So, keep your eye on that story. A big chunk of 2018 was dominated by a strong US dollar, which put a lid on a lot of the foreign investments that are out there. If we start to reverse course there and we start seeing a weak dollar environment, we may very well swing back, at least on a relative basis, where some of these foreign stock markets are going to do better than the United States. We'll just have to see how things shake out there. But that is worth noting here today. On a really ugly day in the United States, you actually saw the rest of the world do quite a bit better. And that was usually not the case in 2018. As we look at this and take a look at where there is some strength, notice that Brazil, I mentioned it before, it was up today, but not only that, it's knocking on the door of hitting multi-month highs here. EWZ is how you can track Brazil. India, although it was down 2% today, remains one of the stronger looking charts on the board there. It's still above that rising moving average, or at least sitting right at it right now. So it had been in a decent little uptrend right there. So keep your eye on India as well. And then Mexico is doing its best to stabilize. Now remember, Mexico fell strongly from October to the end of November, but has done a decent job of stabilizing here since the beginning of December, when the U.S. stock market was falling apart. So if you just look at where Mexico was right here at the beginning of December, and then look at it at the end of December, Mexico was either flat or even up just a hair through the month of December, where the United States suffered what was, basically its worst December since the 1930s. So there is definitely a relative strength shift that's happening towards Mexico. Of course, Mexico in the news here with all of the wrangling back and forth about whether a wall gets built on our southern border or not. But very interesting. Keep your eye on Mexico as well. Let's now take a look at our final 12 grid, which will be our U.S. sectors 12 grid. And as a reminder of how to look at this particular 12 grid, the S&P 500 will be in the upper left, and then the 11 charts following it will be the 11 sectors that make up the S&P 500. So remember that these are large cap sectors. These do not necessarily represent what's happening with small cap sectors, but oftentimes they do kind of trade in tandem. So it's a good way to judge what's going on with a sector. Well, as we look at this, there's a lot of downward facing charts here. Not a surprise. When the S&P 500 has struggled as much as it has, it's going to be hard to find any charts that look good. Now, notice that there are a few charts that are green. We have the financials up here, we have the discretionary, we have the staples, and we have energy. Now, before we get too excited about the fact that the intermediate term line on the market forecast technical indicator suggests a bullish posture on those four, keep in mind that some of you will believe that price is king. It's the only thing. And if you're looking at price is below a falling moving average in all of those cases. So it's great to see that we got a little bit of a posture shift. Perhaps it's the sign that they're stabilizing to a degree and want to start bottoming, but we haven't actually seen that play out in the price action yet. So you still want to be quite cautious if you're trading markets to the upside. If you're investing for the long term, that's a different story. You're out there, searching for value in places that have gotten hit. But if you're trading, especially swing trading back and forth from one week to the next, you typically want the moving averages to be pointing in the direction where you want the securities to go. And right now, all of these sectors have their moving averages pointing lower. So not necessarily a great sign there. Of course, today was the big Apple day, and you can see Apple really affected XLK. XLK was down 5.05% today. That is a massive day for the entire technology sector. Remember that the technology sector is one of the biggest sectors out there because of its huge components within it from a market cap perspective. So to see the XLK down 5% in one day is quite remarkable. You do not see that very often. Other areas that really got hit today were the industrials down 3%, and then you also saw the materials down 2.8%. And I kind of hinted at that a little bit earlier. I suppose we should just as well jump into the trade action here today. Our trade application example is going to come in from that material space. So for this, I'm going to come on over here to our chart 4A, and I'm going to pull up ticker symbol XLB. Ticker symbol XLB. So as we've got that pulled up here, keep in mind that the background color of this chart is now reverted back to the way that the market forecast technical indicator, which is this indicator that you see down below with 3 different colored lines. The background color of the chart up here will kind of give you a clue as far as whether you have bullish or bearish posture using the intermediate term line. Now remember, the intermediate term line is this green line that you see down below. We kind of use that as our default posture setting tool. But keep in mind that not all of you are intermediate term trend traders, right? So if you're more of a swing trader, then you might be a little bit more apt to use the blue line. If you're more of a day trader, you might use the red line. But a lot of times we do focus first off on that green line. And right now you'll notice that XLB just went bearish here today with that big pullback. I mentioned they were down about 2.8% on XLB here today. These are the materials stocks that, of course, are economically cyclical. And therefore, if Apple is coming out in pre-warning, there's probably some fear out there that there may be a greater economic slowdown on the horizon. And that did hit a number of these stocks here today. So what I thought we would do for our trade application example is a bearish trade on XLB now that we have a bearish posture on it once again. And of course, we remain below a falling moving average here, as you can see through the lens of that red color that the tip of the moving average is showing us. And so what I thought we would do here is pull up what's known as a bear call spread. Now you can see that I've already got that pulled up down below here, but if you wanted to pull it up on your own, what I did was I came over here to the Thinkorswim paper money platform, came out to the February options contracts that have 43 days left until expiration, and then I came over here to about our 30 delta. Notice that we have a 29 delta in this particular case, and that's your $52 strike, and I've loaded up a $2 wide bear call spread. So down below you can see that the trade is loaded up where I'm selling. So notice the minus sign in front of the 1 right there. So that means I'm selling the $52 call. And then the line just below it says the plus sign. I'm buying the $54 call with it. So the combination of those two things, when you're selling a call and buying the call in the same trade, is a net effect of 49 cents. Now, keep in mind that we typically will try to get at least 30% return on risk. And so if you wanted to see what that return on risk would be, you can click on confirm and send once here to get the needed data, and then pull up your calculator, look at $49, which in this case, if we're just doing one contract here for paper money, 49 bucks max profit divided by 151, which is your max loss. That equates to a return of risk of 32%. So just barely over that 30% hurdle that we're looking for. Now, just because it hits our return on risk requirements doesn't necessarily mean that the trade setup is ideal. Each one of you has to kind of decide that for yourself and what you're looking to achieve. But as I look at the chart back over here, notice that $52 where we would be short on this particular spread is about at the exact area where we have that falling 30-day moving average right now. So if you believe that that 30-day moving average can act as resistance, perhaps that's one more reason to believe that your break-even point would be a bit safer there. Because remember, we would actually have another about 50 cents worth of cushion there. So technically our break even would be at $52.49. So that would be about, let's call it right around that area that I'm pointing at the chart. So if you believe that XLB will stay below that area that I'm pointing at on the chart from now until the expiration there in February, then perhaps this is a trade that you would be interested in. If you believe that XLB will be above that area, if you think the whole stock market will start rallying here, then of course you're not going to want to take a trade like that. So entirely up to you and what your perception is of the situation. But factually speaking, what we can say is that according to the market forecast, we do have a bearish posture according to that green line on the market forecast, and we do have kind of that reversion to the mean and now a bounce back down away from that falling moving average right there. So let me come back on over here to the trade tab. I'll click confirm and send again. Review it one last time. Everything looks good there. So send that back in and we'll see if we can get filled on that first thing in the morning. All right, well, I want to thank you for joining me here tonight. It's great to be back in the swing of things. Let's hope 2019 is a fun year, an educational year for the stock market, and hopefully a profitable one as well. But as always, David and I are going to do our best for you here on these Market Outlook videos. So remember, if you got value out of tonight's video, if you enjoyed the analysis, make sure you click like and retweet there on Twitter for us and give us the thumbs up and all that fun stuff. David should be back with you tomorrow, and then we'll have a full class schedule again starting next week for those of you that are premium market scholars. So until then, best of success with your trades and your investments. Goodbye for now.